Headlines continue to be dominated by the European debt crisis, and investors are still looking for new measures to counter the bloc's debt crisis. But there's plenty of data coming out next week that will paint a clearer picture about the global economy. Mike van Dulken, head of research at Accendo Markets, joins me on the phone now to discuss the week ahead for financial markets. Mike, before we start discussing some of next week's individual news events in more detail, can you tell me what you think market players could and should be paying close attention to next week?
Yeah, macro data points towards the end of the week. Next week we've got eurozone sentiment, US jobs, China PMI manufacturing and eurozone employment. Now, these are all key to the picture of whether the US is recovering, Europe's still struggling, and whether China's slowing down or not. And I guess key also is the US managing to hold itself up? Is there a bit of reverse decoupling, if you like? And then again, the eurozone is sure to remain dominant. In terms of individual data points, I see 5 main ones. The Friday's non-farm payrolls will always garner much attention. Consensus looking for a rise of about 155,000 after a poor 115,000 last month. But on Thursday you've got a whole array of other jobless data which could in fact impact consensus on non-farms if they are vastly above or below consensus. On Thursday we've got the US GDP, and consensus is looking for a slowdown in annualised figure from 2.2%, the advanced figure down to 1.8, so we're still growing. And on Friday we've got the Chinese PMI manufacturing, which is very keenly watched, China slowing or not. And we've already had the HSBC flash figure, which showed contraction, i.e. sub 50, but there's been a big disparity in the last little while between the HSBC figures and the official ones, so we'll be looking whether that is still the case. US ISM manufacturing seen a touch lower, but still growing, and then as I mentioned, the eurozone unemployment is seen to remain pretty elevated, around 11%, as austerity and slow growth bite.
We've got an array of US data which should back up what kind of economic situation the economy is in at the moment. But should we be looking beyond some of these positive economic signs, as the next big drag on the economy that has got the markets nervous is this fiscal cliff looming over the US? Do you think the US is en route for another recession?
Potentially, we've got a problem, but unlikely. I'm sure that the lawmakers will act just in time, and I'm sure many are hoping that the EU leaders do the same, just in time. But at the moment, most people are worried about the fallout from the eurozone and potentially slowing China. The markets are very short-termist at the moment. In terms of that fiscal cliff, I guess it equates to a reversal of pro-growth measures. It's a bit like switching to austerity, which would likely harm the economy. And if we look at the UK and the eurozone, there's plenty of monetary stimulus, but still struggling on account of austerity. And, a worsening of the eurozone crisis likely to see a flight to the dollar, which would harm US exports, which would dent growth. The Fed's already at a floor with the rates, more money printing to weaken the dollar. The market and the dollar are already swaying based on mixed macro, sovereign and stimulus sentiment. Data remains mixed, but one constant is that jobs in the US is still not recovering quick enough. GDP is in a far better state than Europe, but we'll have to wait and see on Thursday and Friday whether this remains the case. Do we see a bigger revision in US GDP from the advanced figure than expected?
UK data released this week revealed the UK economy has slipped deeper into recession than first expected. What does this mean for the prospect of more QE and moves by the Bank of England?
I believe the potential for more QE has risen after that weak retail sales and GDP downwards revision after that collapse in construction output. The BOE vote was 8-1 against more QE, but it was clarified that it was finely balanced. So the door, that signals to me the door remains open for more stimulus, and fingers may well just be on the buzzer for the next month or two. And again, as I think it's been mentioned everywhere, the important hinge factor is the Greek election, the outcome of which is an unknown, but we've got increasing support for the anti-austerity parties, and that has risen. And I guess the election amounts to a quasi referendum on do they stay in the euro or not.
So the eurozone debt crisis will remain obviously at the forefront of things as the markets are desperate for some tangible outcomes. What's your opinion on the role of the ECB, the need for greater fiscal consolidation, and of course this hot topic of the issuance of eurobonds?
Well, after the poor PMI data yesterday from Europe and the flat-ish year-on-year GDP we saw for the eurozone last week, the potential for the ECB to cut rates has risen, or the calls for it has risen, as has the chance of more stimulus via LTRO or L3RO as we're calling it. The crisis itself and the potential for more intervention has seen the euro now fall to 20-month lows versus the dollar. We're down there, we've hit lows of 1.25, and we're also now below a trend line of 11-year rising support, and below that I don't really see support down to 119. On the topic of the eurobonds, it's going to remain a heated point for the next while. Germany doesn't want it, the others do, and we can see why each party would feel as they do. Germany doesn't want to pay any more than it has to, and it can get money pretty cheaply at the moment, if not almost for free, whereas the others want it because they're having to pay through the nose.
Finally, Mike, Greece is obviously keeping the markets on its toes and not forgetting Italy and Spain's debt as well as banking system. Do you see any developments here taking place over the next few weeks? And what about Italy and Spain's borrowing costs?
Over the next few weeks, I don't think anyone expects Greece not to drive the market sentiment. And, Spain's financial sector woes are likely to add a nice, healthy dollop of contagion risk as we go along. The EU leaders decided to work towards the next summit rather than them announcing specific measures the other day on Greece or indeed on assistance to the banking sector. The problem is that election, the Greek election, is before that. As I mentioned, it's effectively a referendum on the euro membership. So it's possible the leaders are waiting to see the lay of the land after that election. As I mentioned, the far left is gaining support. Are they playing hardball or are they bluffing? Possibly the leaders are waiting to see if the ECB pulls the trigger rather than them. Will we get another LTRO? Will they look at direct bank assistance? Are they allowed to? Draghi's saying that's against the treaty, against his mandate, etc. Of note today is actually now we've got the recently part nationalised bank here looking likely to have yet more money pumped into it, which isn't really a good start for the sector. So the borrowing costs are likely to remain elevated.
Mike, thank you very much. A great insight there for our viewers. Now that's all for now on DukascopyTV, but do join us next week for more financial news and updates on the Forex market. Goodbye for now.